Hi, this is Mike Larson for Money and Markets TV. We all know that Europe is ground zero of the current sovereign debt crisis. Developments in Italy, Greece, and the rest of the PIGS nations are driving the action in virtually every market around the world, from stocks to bonds to currencies. So the 4-day trip I just took to Germany couldn't have come at a better time. I had the privilege of sharing my views on the global economy and markets with a couple hundred Germans and talking about the latest developments with colleagues and average citizens. This boots-on-the-ground approach told me that the eurozone bailouts are wildly unpopular in the country that really has to finance them. Forget the empty promises and happy talk coming from European politicians. The truth is that there's simply not enough money to bail out all the nations that need it. There's not even enough money to rescue the one nation that may need it the most right now, Italy. Italy has more than $2.7 trillion of debt outstanding, making it the third largest sovereign debt market on the planet behind the United States and Japan. The bailout packages of Greece, Portugal, and Ireland are all chump change compared to what Italy would need. And just over the last several days, the dam broke wide open in the Italian bond market. Investors dumped Italy's government debt like mad, driving the yield on the benchmark 10-year Italian note all the way up near 7.5%. That's well above the previous highs set a few months ago, and it's proof positive that both the ECB's bond buying program and the leveraging plan for the European Financial Stability Facility are dismal failures. Meanwhile, average Germans are sick of spending hundreds of billions of euros bailing out rich bankers in profligate eurozone countries, and they're unhappy with the euro currency itself. But they know that the United States isn't in any better shape, and they can't believe that U.S. policymakers are trying to give them financial advice when we can't even tackle our own debt and deficit problems. As we speak, the clock is ticking down to the November 23rd deadline for the so-called Super Committee to recommend huge new measures to cut the budget deficit. But the two sides remain hopelessly deadlocked. Democrats are unwilling to slash entitlement programs like Medicare without tax hikes, while Republicans are unwilling to consider any deal that includes such revenue-raising measures. That virtually guarantees the Super Committee is going to be a super disaster. Heck, Congress is a month into the fiscal 2012 budget year, and it hasn't managed to pass even one of the 12 annual regular appropriations bills that fund the government. What a joke. And how is this slow-motion disaster playing out in the markets? Well, I think the clearest answer is coming from the bond markets. They're often smarter than the stock market. Or in other words, a collapse in risky debt securities often serves as a leading indicator for equities. And right now, the message from the bond market is unmistakable. We are in major, serious trouble. And this is a clear warning to me that stocks are about to tank again, especially if the Super Committee goes down in flames as I expect. But you don't have to just sit there and let your wealth evaporate. Take your profits in the equity markets off the table, and then for your more aggressive funds, consider going on the offense, buying select investments that rise in value when stocks fall. I'm Mike Larson for Money and Markets TV. Thanks for watching.